Okay, so we have to start with chapter 3, revision, feasibility study. Feasibility study is part of the business idea. So the first thing is we come up with a business idea. So as soon as you come up with a business idea, you don't just execute that idea. You have to investigate the potential profits, the potential threats on that idea. And that is where feasibility study comes into place. Are you with me, please? So there's feasibility study, which is an investigative report into the potential and profitability of a business idea. So it's all about the business idea. So when there's a business idea, you don't just execute the idea, you investigate the profitability of that idea, the potentials in that idea before you execute it. And that is what feasibility study is about. You get feasibility study here. So here I wrote, it's an investigative report into the potential and profitability of a business idea. The business idea is there. Oh, we want to create this product, or we want to produce this product, or we want to render this service. But what are the potentials in these services? What is the profitability in this service? That is why we need feasibility study. Is feasibility study clear? So what are the areas of feasibility study? I didn't write it here. I'm going to talk about it now. We have different areas of feasibility study. We have the technical area. For technical area, we're simply talking about technology, software, and skills. That is technical. Then we have financial, which is going to talk about the profitability and the revenue, and also the cost of that study. And the last area is the operational. For operational, we're going to talk about raw materials. We're going to talk about skills needed, skills of labor. We're going to talk about tools or equipment needed, and the cost. The financial capability, that is about the three areas of feasibility study. We have technical, we have financial, and we have operational. I think those ones are clear. Now we go to the types of feasibility study. For the types of feasibility study, we have the first one is market feasibility. Are you with me, please? When we talk about market feasibility, here I wrote, it determines whether there is demand for products or service in a specific market. So we call it market feasibility because you can't just produce a product because you have make a research and the product is going to be selling. You have to make if you want the product to sell, it simply means you have to produce goods and services or services that consumers are willing to buy. So that is why you need market feasibility. So market feasibility will determine whether the product you want to sell or the service you want to render is in demand in the market. A market is a place of contact between buyers and sellers. So the feasibility in the market allows you to determine if whatever you want to produce is going to sell or not. That is market feasibility. Do you get that? Do you get it or not, please? Okay. Let me just be sure about what we're doing here. Okay. So, financial feasibility. For financial feasibility, it assesses if the business idea is financially sustainable and profitable. Finance is a disbursement of funds from the surplus unit to the deficit unit. Finance is about how you raise money to start the business. So, why do you have to go through financial feasibility? You're going through financial feasibility to assess, to monitor, to identify if the cash you have is going to be enough to set the business. So that is financial feasibility. So it assesses the business idea, if the business idea is financially sustainable. Do we have enough finance to carry out this operation or not? And aside that, because whatever you talk about finance is about the cost and the benefit, which is the profit. So financial feasibility will tell you if the amount of money you're going to spend would allow you to generate revenue that would allow you to make profits. So that is financial feasibility. It assesses if the business idea is financially sustainable and profitable, because the reward for an entrepreneur is profit. So if we're going to embark on this business, are we going to be able to make profit or not? That is the point about financial feasibility. Is it clear? The next one, production feasibility. Are you there? So for production feasibility, it's about evaluating the possibility of the business to produce the product efficiently and affordably. Yes, the business idea is to produce this pen. Are we going to be able to produce this pen efficiently? That means we're not going to waste resources in the course of producing this pen. We need to be sure about that. And can we afford it? If not, we can outsource it. So production feasibility is about if we have the capability to produce the pen because this is what the business idea is, to produce pens. If we have the financial, we have the capability to produce these pens without running at a loss, without wasting resources, that is production feasibility. So we need efficiency when we are producing. Do you get that? Are you sure, please? And the next one is skills feasibility. We can't produce product without workers, yes or no? So there's skill feasibility to examine whether we have the skills required to execute that project. Do we have the workers needed to produce these products? If we have the workers, do they have the necessary skills required to be able to carry out or execute the production? If not, do we need to train them? That's about skills feasibility. So it's about checking the number of staff you have. Do they have the skills required to produce the product? Yeah, it's a business idea. Yeah, we want to produce pens. Do we have workers that can produce this pen? If we have, do they have the skills required to produce this pen? If they don't have, what can we do? We train them, because training would improve your technical know-how. Training will improve your skills, your knowledge. So if we don't have the required workers, we have them in number, in quantity, we don't have them in quality. So we need them in quality. To get them in quality, we need to train them. That is skills feasibility. Do you get skills feasibility? The next one is environmental feasibility. Here, it assesses the project's potential on environmental impacts. If we are producing pens, are we sure we're not going to damage the environment? Pollution, carbon emission, are we sure these things are not going to be there? We need to be sure. We need to protect the environment, not to damage the environment. And that is what environmental feasibility is about. Do you get it? So any question about types of feasibility studies? We have production feasibility study, we have financial feasibility study, we have market feasibility study, we have skills feasibility study, and environmental feasibility study. Any question about that? Then we'll move on to the importance of conducting feasibility study. Are you there? So what are the importance of conducting feasibility study? The first one, it assesses the viability of the business idea. That is the point. When you do feasibility study, what does that simply mean? It simply means you want to check if this idea should carry on or not. Yeah, we have the business idea. Should we execute this idea or shouldn't we execute this idea? It's a question about you doing or not doing. And the only way you could know, the only way you can know to either to execute or not to execute is carrying out feasibility study. Because feasibility study allows you to assess the potential profits or threats in the course of producing that product. So with feasibility study, you can see the end from the beginning. Do you get the point here? So it assesses the viability of the business idea as decision makers use the study to decide if the project should move forward or not. So if you're going to execute this project or product or business, it is through feasibility study that will give us knowledge about carrying on or stopping it. That's the first advantage. The second one, it supports informed decision making. Because it's feasibility study, it simply means we've gathered information, statistics, data, figures, and facts. And because we've gathered all this information, it allows us to make the right decision. And making the right decision means you are making informed decision. So with feasibility study, because we have information with us, it allows us to make informed decision. Does it make sense? The third one, it identifies potential risks and challenges. With feasibility study, let's look at production feasibility, environmental feasibility. It allows us to know if whatever we're doing will damage the society or it's hazardous. Or with feasibility study, we'll be able to know the risk involved in that production. So now that we know the risk, we have to manage the risk. How do we manage risk? Risk can be managed. Risk management simply means we identify, we assess, we look out for strategies to avoid risk, to reduce risk, or to transfer risk. That is what risk management will do. And without feasibility study, we won't be able to manage the risk. Do you understand the third one? And the fourth one, reduce costly mistake. Businesses may be able to avoid businesses that have the potential to fail. Because you have done feasibility study, maybe production feasibility. With production feasibility, you would know if you can produce the product efficiently or not. As a result of that, you would be able to decide or determine if you carry on with the project or not. Oh, this project is full of risk. We cannot afford it. Then we stop it. So the business is not going to fail. So if your business is not going to fail, it is based on the kind of feasibility study you do. So with your feasibility study, you would know if the business has the potential to fail or potential to succeed. So if it has the potential to succeed, you carry on with the project. That means it's not going to fail. But if it has the potential to fail, then you might withdraw or seek alternative. Is it clear? Any question about that? So that's about feasibility study. Is it clear? Thank you. So we go to chapter 4 now. So you're going to send it to me, please. So go to chapter 4. Shall we? Okay, so now in chapter 4. For chapter 4, it's about business ownership. Are you there? For business ownership, it is a legal and financial control over a business entity. So there's business ownership because you have the control. It's your business. And because it's your business, you have the legal control and the financial responsibility to take over the business. That is what business ownership is about. Do you get it? It is the legal and financial control over an organization, over a business entity, over a business. So the control you have over a business, your financial responsibility over a business makes you the owner of the business. That is business ownership. Do you get that? Do you get it or not, please? Good. Then, what are the nature of business ownership? We're talking about the factors that we have to consider when deciding business ownership. Yeah, we have types of enterprise. We don't need to talk about that. So we go to nature factors to be considered when deciding on business ownership or options. Number one, the formation. When we talk about formation, we're simply talking about the level of complication and the cost of setting up. So the kind of business you want to do, we have different types of business. We have sole trader, we have partnership, we have private limited company, we have a public limited company, we have franchise, we have cooperative, and so on. So the kind of business you do will be based on your own decision regarding how complicated and the cost of setting up the business. So if you are looking for a low-cost business, that means you have to think about sole trader. That is the point here. And if you are looking for a business that is less complicated, it has to be what? A sole trader. So a business that is less complicated and that has low cost is sole trader, and that is formation. So the formation of your business, if you are putting into consideration the cost and the level of complication, then you have to think about sole trader. But if you don't care about the cost and the level of complication, you can think about other type of businesses. That is formation. So formation is one of those things you have to put into consideration when you want to decide on business ownership structure. Options. Number 2, liability. Liability is simply about the debt to the third party. So the extent to which you can accept liability will determine the kind of business you want to run. If you think, oh, you don't want the debt of the business to affect you, you don't want the liability of the business to affect you, then you think about private limited company or public limited company. But if you don't care about the liability affecting you, you can think about sole trader or partnership liability. You get that? Mm-hmm. The third one is finance, the ability to raise capital and attract investors. If you really want to attract investors, you have to start thinking about a private limited company or mostly public limited company, or partnership. A sole trader is only by you. So a sole trader will not attract investors because it's your own business. But if you're thinking about how to raise more capital to set up the business, then you can think about partnership, you can think about private limited company, you can think about public limited company. That's about finance. These are the features, things you have to put into consideration when you are setting up a business or when you are deciding on business options you have. The next one is control. The degree of control that you want will determine the kind of business you run. So if you want a sole trader, it simply means if you want to take full charge, full decision-making of the business, that means you have to run a sole trade business. If you do not care about sharing control or decision-making with others, you can run a partnership. If you don't care about losing control of the business to share others, you can run a public limited company. So how much control you want will decide the kind of business ownership you have. That is control. You get control here. The next one is separate legal entity. Legal entity is about the difference between your business and the owner of the business. So if you think about having the business separate from the owner of the business, then you can think about private limited company and public limited company. But if you don't want to separate the business from the owners of the business, you can run a sole trader or partnership. So the distinction between the business and the owners is what we call separate legal entity. So if you want the business to be you and you the business, then you think about sole trader or partnership. But if you want the business to be separated from you, then you think about private limited company or public limited company. Do you get that? Then the next one is taxation. Different taxes are charged on different business structures. There's income tax and there's corporation tax. Income tax is a tax levied on individuals, sole traders, and partnership. For corporation tax, these are taxes levied on private limited companies, public limited companies, cooperative societies, and the rest. So the kind of tax you want will decide the business ownership. So if you are thinking about low tax, you can think about becoming a public or private limited company. But if you don't care about the tax, then you can choose to be sole trader or partnership. It's all about your decision anyway. Then regulatory requirements. For regulatory requirements, we're simply talking about how you publish your financial statement. If you want confidentiality, that means you don't want to publish your financial statement, you can think about a sole trader or partnership. But if you don't care about publishing your financial statement, you can think about a private limited company or public limited company. That is about regulatory requirement. Do you get that? And the next one is dissolution. For dissolution, we're simply talking about how the business will end. A sole trader business ends by you. You are the owner of the business, you can end the business. Or if the owner of the business passes away, the business can end. Partnership, it is a mutual agreement business. It can mutually stop the business. Sole trader and partnership, it doesn't really stop, but it can be stopped if they are bankrupt or government, there's a court order to stop the business. That is dissolution. And the last one is continuity of existence. Are you there? So for continuity of existence, it's simply talking about a change in ownership structure that will bring about the end to the business. A sole trader does not have continuity of existence. A partnership business does not have continuity of existence. Private limited company has continuity of existence. Public limited company has continuity of existence. Do you get that? Do you get that, please? Okay. So that's about factors to consider when deciding on business ownership options. That's page 61. Now we go to the types of business ownership. For types of business ownership, we're simply talking about the kind of business we have. We have sole trader, like I said earlier. We have partnership. We have cooperative society. We have franchise. We have private limited company. We have public limited company. I'm going to talk about them now. Are you there? So we're going to start with sole trader. So for sole trader is a business that is owned and controlled by an individual. That's a sole trader, page 62. Are you there? So we call it a sole trader because it's a business that is owned and controlled by you. You own the business. That's a sole trader. So what are the features of a sole trader? We start with the formation. For every business, irrespective of it being a sole trader, partnership, or whatever it is, it has to go, in Ireland, it has to go through the Company Registration Office, CRO. So the formation is that it must register with the CRO. That's formation. Do you get that? Please let me have your phone. Let me make another video there. Thank you. So for sole trader, I said a sole trader is a business owned and controlled by an individual. So it simply means you own the business, you control the business, it's your decision to start the business. That makes you a sole trader. So the features, what are the features of a sole trader? We start with the formation. Formation is how the business is started. So to start the business, you have to register through the Company's Registration Office, CRO. The liability, It has unlimited liability, which simply means the debt of the business can affect the owners of the business. So the debt of the liability of the business can be transferred to the private assets of the owners of the business. So if the business is owing, they might sell your car, they might sell your personal wealth to pay for the debt of the business. Finance for sole trader, mostly because it's your business, it has to come through, the finance comes through your savings, personal savings. Do you get that? Control, you are the sole trader, it's a sole trader, so that means all the decisions about the business, you make the decision. Do you get that? Does it have a separate legal entity? No, because a sole trader is an unlimited liability. So it simply means you cannot distinguish the business from the owners. Taxation, they pay the same tax as employees, income tax. Regulatory requirements, no, they don't publish their financial statement. So there's minimum requirement. They do not publish. There's confidentiality. Dissolution, how does the business end? A sole trade business, it ends by the decision of the owner of the business, or it ends if the business owner passes away. Did you get that? Does it have continuity of existence? Remember, continuity of existence means a change in structure that ends the business. If it doesn't have continuity of existence, because if the owner of the business is changing, that means the business is being handed over to someone else, and the person that is being handed over to starts the business. So there's no continuity of existence for a sole trader. So what are the advantages and disadvantages of a sole trader? The first advantage is that it is easy to set up. You can as well set it up in your house. Downstairs, you can start a business. There's a sole trade business. It is easy. There's no paperwork needed. That's why it is easy. 2, owners retain the profit. So whatever profit you make, all your return on investment, you keep it. That's an advantage. Or is it not an advantage? Is it? Is it an advantage or not? When you keep all the profit, it's an advantage. It's beneficial. The third one, full control over the business decision. It's your business. You make decisions about it. That's an advantage too. Now, what are the problems when you start a sole trade business? Number 1, lack of expertise in all business areas. You can start the business, but there's no one that is cosmopolitan. No one is a cosmopolitan. You can't have all knowledge about the business. So which simply means you might have some weaknesses, and those weaknesses might affect your operation. That's the first disadvantage or demerits or problems or setbacks about sole trader. The second one, personal liability for debts. It's unlimited liability. But remember, even partnership, it's unlimited liability, but debts in partnership can be shared losses in the partnership can be shared among the partners. But as a sole trader, whatever liability you have to solely bear it. And the third one, full responsibility, which can lead to stress. You can get stressed up because you have to be there every now and then. You are the only one in charge. You cannot share your responsibility with others. And that could lead to stress. So these are about sole trader. Any question about sole trader? Good. So I'll get the video too. Thank you. So go to partnership. Are you there? So for partnership, we're simply talking about a business that is owned by 2 to 20 people with the aim of making profit. Partnership is what? A business that is owned and controlled by 2 to 20 people with the aim of making profit. And as soon as they make this profit, they have to share the profit. That is the point. They have to share the profit. Do you get that? Do you get that, please? Okay. So what are the features? We need to know the features too. The features of partnership, the formation. Any business has to be registered through the CRO, Companies Registration Office. Any business that you're doing. In Ireland, you have to go through the CRO. But your method of registration differs. A private limited, a sole trader and partnership, you just have to register. When it comes to private limited company, public limited company, you have to go with constitution, you have to go with AOA, which is Article of Association, you have to go with MOA, which is Memorandum of Association. We're going to talk about that later on anyway. But for partnership, the formation is just to register through the CRO. Liability is unlimited, which simply means the liability of the business can be transferred to the personal wealth of the owners. Finance, the 2 to 20 people will be the ones to finance the business. The control, the 2 to 20 people are the ones in charge of the business. Any question about that? Separate legal entity, no. There's no difference between the business and the owners, the 20 people that owns the business. There's no difference between them. Taxation, they pay the same tax as a sole trader, which is income tax. Regulatory requirements, minimum. So they don't publish their financial statement like sole trader. Dissolution. They started the business with mutual agreement, right? 2 to 20 people come together, they agree to start the business, right? So at the same time, they can also come together, stop the business through mutual agreement. Or maybe one of the partners die or passes away, or one of the partners resign. So they have to restart the partnership business. So it doesn't have continuity of existence. That is the point. Continuity of existence, no. Is partnership clear here? Any question about partnership? So go to the advantages and disadvantages of partnership. What are the advantages of partnership? Number one, easy to set up. Just like sole trader, there's no need for a lot of paperwork. Just register through the CRO and that's all. Shared decision making. The problems in sole trader are the advantages in partnership. The problems of the problems in partnership are the advantages in sole trader. Look at here, shared decision making. Because it's a partnership business, different individuals can have different expertise, and that allows them to share the responsibility. But in sole trader, you can't share your responsibility, and that would lead to stress. So, but here you can share decision making, and that could bring about right decision making or proper decision making. Increased access to capital. In sole trader, you have to be the one to find your finance, probably your savings. But with partnership, 2 to 20 people can put money together to start the business. That means they have access to more capital compared to a sole trader. So what are the setbacks? Disadvantages is the same as what? Setbacks or problems or drawbacks. They are the same as disadvantages. So the first problem about partnership is that you have to share the profits. How is sharing profit becomes a problem? It's a problem because your return on investment reduces. Unlike a sole trader, you keep all the profits as a sole trader. But in partnership, because the business is owned by 2 to 20 people, so whatever profit you make, you have to share it amongst yourself. And that reduces the kind of return you could have. That's a problem. The second one, potential conflicts between partners. 2 to 20 people are coming together to set up a business. There will be conflict of interest. We won't agree on everything. So whenever there's disagreements, it could bring about a problem. Do you understand conflict of interest there? Slow decision making. All partners have to reach a compromise before they make decision. And slow decision making will bring about what? Poor decision making. Any question about partnership? So that's about partnership. Now we go to cooperative. You just have to know the meaning of a cooperative society. A cooperative society is a business that is owned and controlled by the members for mutual benefits. We have teachers cooperative society. When all teachers come together to form a cooperative society, we call it teachers cooperative society. We can have doctors cooperative societies. We can have farmers cooperative societies. We can have markets. They are cooperative society, but they are businesses that are formed by members. They have to be of the same profession, like teachers, like doctors, like lawyers. They have to be of the same profession before they can start a cooperative society. So cooperative is what? A form of business owned and controlled by members for mutual benefits. So they are starting the business because of their own benefits. Do you get that? Any question about that? So we don't need the formation. So we'll move on to franchise. Are you there? So for franchise, we are talking about an agreement between the franchisor and the franchisee, which allows the franchisee to use the franchisor's brand name for business operation. That is franchise. Are you there? So franchise is what? An agreement between the franchisor and the franchisee to use the franchisor's brand name for business operation. Who is the franchisor? The franchisor is the owner of the business. The franchisee is the business that is willing to use the brand name. So let's take an example of KFC. KFC is in America, I think. Okay. So if KFC is in America, there could be KFC in Tripoli. So the KFC in Tripoli might be owned by a Libyan. You can have a KFC here. But having a KFC here means you are buying a franchise from KFC in America. So you are the franchisee. It's your business, but you are the manager of the franchise. The KFC that sold the franchise to you is the franchisor. So because you are willing to use KFC as a business, as a brand name for your business here, you have taken a franchise. So that's why franchise is what? An agreement between the franchisor, which is KFC, and the franchisee, which is you, to allow you to use the brand name of KFC to start up a business. Is it clear? Any question about that? Then go to company. What's a company? A company is an incorporated business. So we have two types of company. We have the private limited company and the public limited company. Are you there? Yeah, company. We have private. Okay, yes. What else do we need to talk about here? Company. Okay, yes, we have private limited company. Go to page 66. Private limited company. So those ones are not important. I'm skipping them. So we have private limited company, page 66. Are you there? So a private limited company is a company that is owned by shareholders, but these shareholders are friends and family. So it's a private limited company. I did not write the definition here, right? So let me write it here. A private limited company, it is a business that is owned by shareholders who are likely friends and family.
That's perfect.
No, private. A private limited company is a company that is owned, or a business that is owned by shareholders who are likely to be what? Friends and family. That is a private limited company. Do you get a private limited company here? Do you get it? We have different types of private limited company, but we don't need them. We only need the private limited company. So what are the formations of a private limited company? Number one, the founders must submit constitution, MOA, AOA to the CRO. Just like any other business, a private limited company, if it has to be formed, they have to submit the constitution of the business, the memorandum of association, the article of association. Then we have liability. It is limited liability. Are you there? Focus here, because I split them. So for the liability of, these are the features now, features of private limited company. Are you with me? So for the features of private limited company, we have the formation, which is the founders must submit the constitution, the MOA, and the AOA to the CRO. Then the liability is what? Limited liability, which simply means the owners of the shareholders can only lose their investment in case of death. They cannot lose their personal wealth. That is limited. Finance, issuing of shares or obtaining a loan. They can take a loan from the bank or sell shares to friends and family. Do you get that? For private limited company. Then the control. The proposition of shares owned determines the business decision. So business decision is based on the owners of the shares. How many shares do we have? That determines the ownership. Do you get that? All right, just hold on, please. I need to pause here. Now we have the control is most of the time private limited companies are controlled by the owners of the shares, which are the friends and the family. They control it. They are the board of directors. There's separate legal entity. Yes, they have separate legal entity, which simply means the owners are different from the business. Taxation, they pay corporation tax, not the same as income tax that sole trader and partnership will pay. Regulatory requirements, they have to file annual returns and financial statements. That means they have to publish their financial statements, unlike sole trader and partnership. Are you with me? Dissolution, how can the business end? The business can end through the shareholders or court order. Continuity of existence, yes. Because friends and family, they can continue the business even if one of the owner dies or passes away. Any question about that? So we don't need these ones. We'll go to public limited companies here. Are you with me? We did private limited company. Now we're doing public limited company. A public limited company is a publicly traded company whose shares can be bought and sold in the stock exchange market. So the difference between a private limited company and a public limited company is that a private limited company is owned by friends and family, but a public limited company can sell its shares by issuing IPO, which is initial public offering, through the stock exchange. So that means you can sell your shares to the public. That makes you a public limited company. It's not the same as a public corporation. A public corporation is a company owned by government. But here we're talking about a public limited company, which simply means you can sell your shares to anyone. That's a public limited company. Is it clear? Do you get that? Okay, great. Now we move on. What are the formation? Formation requires registration with the CRO. You have to register through the CRO by providing the constitution, the MOA, and the AOA, same as the private limited company. Liability is limited because the owners are separated. Whatever happens to the business does not affect the owners of the business. So which simply means the only thing the owners of the business would lose is the investment into the business. Finance, they can raise capital by selling shares through issuing of shares. They can sell shares to anybody. The control, it's through the shareholders. They have the voting rights. Separate legal entity, yes. You know, we're talking about the features here. Separate legal entity, yes. Taxation, it is also corporate tax. The regulatory requirement, it is they have to publish their financial report like the private limited company. Dissolution through court order or the shareholders. Do you get that? Then what are the advantages and disadvantages of public? Hold on, please. Just hold on, please. Let me just pause here. Take this. Pause. And okay, pause. Okay, so now the advantages and disadvantages of public limited company. Unlimited access to capital as they can sell their shares to the public. They have unlimited access to money, capital, because they can sell shares to friends and they can sell shares to anyone. That makes them to have more financial capability, easier to attract top talents. It's a public limited company, and a public limited company has the financial capability to pay skilled workers. They can pay anyone because they have money. So that allows them to attract top talents. Potential for significant growth. They can expand at any point in time because it's a big business. What are the problems or limitations to or disadvantages of public limited company? Number one, it is costly and complex to set up. You need to provide constitution, you need to provide MOA, you need to provide AOA to the CRO. This takes time, and whatever takes time takes money. That is why it is expensive to set up. Two, lack of confidentiality. There's lack of confidentiality because you have to submit, you have to publish your financial statements, unlike sole trader and partnership. Extensive regulatory burdens. It involves a lot of paperwork, and government eyes are always on you. Any question about that? Now we go to, so we go to how business ownership may change over time. So how business ownership may change over time is based on the stages of business. So please, I need your phone for that too. Thank you. So how business ownership may change over time. So business ownership may change over time based on the transition between when you start the business, the growth stage, the maturity stage, the renewal or exit stage. So we're going to start with the startup stage. A business that is just starting up would not have that financial capability to be so big. So most of the businesses that are in the startup stage, they are run through sole trader or partnership. So in the startup stage, the most common business ownership is sole trader or partnership, because at that time, you might not have the financial capability to expand or to compete with large businesses. So you want to start small. So during the startup stage, the most common kind of business is what? Sole trader and partnership. Do you understand startup stage here? Now, the growth stage. In the growth stage, it's about the business trying to expand. So at that point in time, the business would need access to capital. So because you need access to capital, you might transit from sole trader to private limited company, or from partnership to private limited company or public limited company, because you can't continue as a sole trader to expand. It's difficult. your savings, your retained profits might not be enough for your expansion. So you need accessibility to more capital, and that might allow you to become a private limited company involving friends and family. So during the growth stage, a business needs access to capital to be able to expand. It might have as well changed to a private limited company or issue IPO to become a public limited company. That is the growth stage. Then we have the mature stage. For the mature stage, this is the stage where you pursue, where you think about becoming so big and continuity. At that stage, you might, if you have not become a public limited company, you can become a public limited company at that stage because you need more capital and support for further expansion. That is the mature stage. And the last stage is the renewal or exit stage. This is the stage where you start thinking about strategies to integrate, to grow, or to exit. So that stage is the stage that you want to think about becoming a multinational. You want to compete with the rest of the world, the rest of your competitors across the world. So you might think about merging with a new business, merging with another business that do the same thing as yours, or buying another business that do the same business as yours. Or if you cannot adapt, then you have to exit the market. If you cannot be relevant in the market, you have to leave the market to cut your loss. So these are the business ownership stages and changes that might occur during those stages. We have the startup stage, which you have mostly sole trader and partnership. You have the growth stage, where you could have private limited company or public limited company. But the mature stage is mostly the public limited company. Then the renewal or exit stage is that stage that you think about further, or you think about growth, you think about adaptability, or you exit. Is it clear? Any question about that? Then we have nationalization and privatization. What is nationalization? Nationalization is the transfer of private businesses to the hands of the government. That is nationalization. And the opposite is the case when it comes to privatization. The transfer of government-owned businesses to the private sector. Like the General Electric Company of Libya is a government-owned business. If the GECO, General Electric Company of Libya, becomes a private-owned, that is privatization. If your school becomes government-owned, that is nationalization. Is it clear? Any question about that? So that ends chapter 4, business ownership. So going to chapter 5. Are you there? Chapter 5. Are you there? So for chapter 5, take care. So go to chapter 5, regulation, governance, and ESG reporting. For regulation, we're simply talking about rules or laws that controls how a business is operating. You can't just start a business and start operating. You have to operate in a certain way. So those rules or laws that bind the way you are being operated is called regulation. Do you understand what regulation is here? Then we have the purposes, or the purpose of regulation, the reasons. It's also reasons for regulation. The first one is to ensure minimum standards are met. When there's regulation, it simply means, oh, there are rules to follow. We can't go down than this, except if we want to go forward. We can't do more than this. We can't go down further. We can't go down beyond this because there's regulation. So the minimum we can do is this because there are laws that guide us. So regulations allows us to understand the minimum we can reach when it comes to standards. Does it make sense? Does it make sense or not, please? Are you with me? Okay. 2, it protects small businesses against large businesses from unfair competition. Without rules, without regulations, it is difficult for businesses, small businesses, to compete with large businesses because large businesses, they have enough. Follow this creator. Oh, thank you, Hilarious. So for large businesses, they have the financial capability to take smaller businesses off the market. But with external regulations, they won't be able to do that because there's government. Do you understand? That's unfair competition. And the third one, it creates standards and moral way of operation. Because there are rules, there are regulations that we have to follow. We have to do things the right way, and that is moral, the principle to know what is right or wrong. Do you get that? Now, are you with me, please?
Mhm.
Then we have types of regulation. For types of regulation, we have internal regulation and external regulation. That is important. Internal regulation and external regulation. For internal regulation, we're simply talking about regulations that come from within the organization. That is internal. Do you understand internal? Internal regulation is what? These are the regulations that come from within the organization, internal. Then that is all you need to know about internal regulations. Is it clear? Then we have external regulations. For external regulations, these are regulations from government. These are what? External regulations. These are what? Regulations from government. That's the meaning here. Okay. Okay, I wrote it. These are laws or rules set by the government or regulatory bodies. That is external regulation. So the difference between internal regulation and external regulation is that internal regulations comes from within the business. External regulation comes from the government or regulatory bodies. Any question about that? Any question? Any question? No. Okay, we move on. Internal and external there. Then we have governance. We go to governance, which is also important. So when you talk about governance, governance is a system of rules, practices, and processes by which a company or a business is being directed and controlled. We have rules and regulations, yes or no? The system that uses these rules and regulations to direct the company is called governance. So governance is a system. Does it make sense to you or not? Governance is what? A system of rules, practices, and processes by which a business is controlled and directed. So those who control the business are the board of directors. They govern the business. They state how the business wants to go. So what are the key roles in governance? We have the board of directors. We call them BOD. The board of directors. They are the ones legally responsible for the governance of the business. The board of directors. Then we have the audit committee. The audit committee, they are in charge of financial reports. Audit committee are in charge of what? Financial reports. Audit committee are in charge of financial reports. It's fine there. Then we have the risk committee. For the risk committee, they ensure risks are identified and managed. How do you manage risk? You manage risk by identifying, assessing, measuring, and creating strategies to reduce the risk, to avoid the risk, or to transfer the risk to the insurance company. That is risk management. Do you understand it? So that's the duty of the risk committee. Then we have the compliance committee. The compliance committee wants to ensure that we follow the rules and regulations stated by government and the company. It ensures the organization complies with legal, regulatory, and internal policy requirements. That is compliance committee. Do you understand compliance committee? So we have the board of directors, which is about who controls the business. We have the audit committee, which decides about the financial side of the business. We have the risk committee, which talks about risk management. We have the compliance committee, which monitors how we are complying with rules internally or externally. Are they clear? Now go to the features now. Features of good governance. When your business is run and directed in an effective way, what are the benefits? Now, what are the features? What are those things we will see in a company that will make us to say that this company is what? A company that is guided, that has good governance. The first one is accountability. The board of directors must be answerable to shareholders. So which simply means the board of directors must give reports about what they do to the owners of the business, to the shareholders. Do you get the first one? Are you sure you are with me? Transparency. The board of directors, the board means the BOD. The board of directors must provide timely, accurate, and clear information to shareholders. They must be transparent. They must provide the shareholders are the ones that have invested in their money to the business. Are they not the one? They are the one. So the board of directors that are there to govern the business must ensure that they give the shareholders information, clear one. They have to be transparent about what the affairs of the organization. So transparency makes good governance. The third one is fairness. My network is breaking? No, I don't think so. It's clear here. Fairness. For fairness, the board must treat shareholders, employees, suppliers, and local communities fairly and with equal consideration. Fairness is about equality. You don't just treat the owners of the business well. You treat the stakeholders. Who are the stakeholders? These are people that have interest in the business activity. These are the stakeholders. So as board of directors, you have to put all of them into equal you have to put them into equal consideration. You don't just treat stakeholders well, shareholders well, you leave customers. Customers should be treated well. Shareholders should be treated well. Government should be treated well. Customers should be treated well. Employees should be treated well. The community should be treated well. That is fairness, equality. Do you get that? Do you get that or not, please? Responsibility. The board must oversee business operations in the best interest of the business. So the directors of the business must think about the business whenever they want to make decisions. Do you understand responsibility here? Then the last one is risk management. The board of management or the board of directors must identify and manage the risk. And whatever is going to bring about destruction or hazard, they must inform those ones that are involved. These are the features of good governance. Any question about features of good governance? Any question, please? Now we go to benefit of good governance. What are the benefits of good governance? So if there's good governance, so what are the benefits? Number one, trust. Because the government is accountable, is transparent, is fair, is responsible, it avoids risk. Stakeholders will trust them. That is trust. It builds trust with investors, shareholders, and government officials. Because of the features of the good governance, then there will be trust. Two, promotes long-term financial stability of the company. Because the business is guided well, the business is following compliance, it simply means the business would not struggle when it comes to financial sustainability. The third one, it helps in the process of raising capital. Because the business is transparent, the business is accountable, the business is compliant, the business is able to manage its risk. It simply means the business will be able to raise more capital because investors will be willing to invest in such a business. It can contribute to raising share prices. Because your business is doing well based on good governance, it means the demand for your shares would increase. Like Apple. Apple is a company, it's doing well. Yes or no? If Apple wants to sell its shares, a lot of people would want to buy. Yes or no? So it simply means because the demand for Apple shares are increasing, the price of shares of Apple would rise. And that will bring about share premium. That's accounting anyway, share premium. Share premium, it's in accounting. And the last one, it also improves the reputation of a business. The business is accountable, the business is responsible, the business is transparent, the business is compliant. This means the business will have a better reputation. And the last one, it reduces the potential for financial loss and corruption. All we've talked about, the features of good governance, means nobody would be able to steal from the company. Is it clear? Any question about that? So go to ESG reporting. Are you there? So for ESG reporting, we only need ESG reporting, this. So ESG reporting means we are informing, we are passing information, we are disclosing information about our environmental impacts, social impacts, and governance to the government. That is ESG reporting. ESG reporting. So here I wrote, it implies to a situation whereby a business shares information about its environmental, social, and governance practices. So when you share information about your social, which is about how you relate with stakeholders, environmental, how you protect the environment, despite the fact that you are producing, that is environmental. Governance, your board of directors, how they treat their employees, how they relate with stakeholders. This is what ESG reporting is about. ESG reporting. It's about sharing information about environmental, social, and governance. Is it clear? So that takes us to the factors to consider in an ESG report. Here we only need to know the factors. We have environmental factors, page 77, please. So for ESG reporting, we have 3 factors to consider. We have the pillar here. environmental pillar, social pillar, and governance pillar. Those are the three things we need to know. So we start with environmental pillar, which is about the organization impact on the earth. That's all you need to know. This pillar focuses on an organizational impact on the earth. That means how we deal with our environment. Are we protecting the environment or we're damaging the environment? That is environmental pillar. Is that clear? Then we have social pillar. For social pillar, it examines how an organization manages relationship with key stakeholders. How do you manage your relationship with your customers? How do you manage relationship with your employees? How do you manage relationship with government? How do you manage relationship with government? How do you manage relationship with the community? How do you manage relationship with your suppliers? How do you manage relationship with the banks? That is social pillar. Is it clear? So let me just show the audience what we're talking about here. Flip camera. So we have three pillars when it comes to ESG reporting. We have environmental, social, and governance. For environmental, it's about information about how we manage the environment, which is about are we damaging the environment or we're protecting the environment, sustainability. Social is about how we relate with our stakeholders. I talked about that now. Then we have governance, which is about the management. Are you with me? So those are the three things you need to know about the ESG reporting. We have social pillar, we have environmental pillar, we have governance pillar. Any questions about that? So that ends chapter 5. So we go to chapter 6. So for chapter 6 is about making informed decision as a consumer. So who is a consumer? A consumer is a person who buy goods for usage. That makes you a consumer. So yeah, consumers are people who buy or use goods and services for personal use rather than for business purpose. So in as much as you are buying a product or service for your personal use, that makes you what? A consumer. Do you understand what a consumer is here? So what are the types of consumer contract? A trader, we're not going to talk about that, but traders are those who sell goods to make profits. Or do you understand traders? So let's talk about the types of consumer contracts. So go to types of consumer contracts. Are you there? So before we go into contract, a contract is an agreement between the buyer and the seller. So as soon as you go to that shop to buy a product, you have created an agreement. That's a contract. So when the consumer buys goods, services, or digital content, they make a contract with the seller. So in as much as you're buying, you have made an agreement with the seller. You have made an agreement. So what are the types of contracts or consumer contracts? Number one, sales contract. Why do we call it a sales contract? A sales contract is an agreement which occurs when a consumer buys a good in the shop. So as soon as you go to that shop downstairs or in your street to buy a product, you have had what? A sales contract with the seller. Contract for services. When the consumer engages a trader to provide service, that is contract for service. I'm teaching you right now is a service. That is contract for service. Digital content contract. This is when you buy digital content. When you are being supplied digital content like ebook, instead of buying the physical book, the hard book, you buy a soft copy. That is digital ebook. Do you understand digital? Then we have digital service contracts. It allows consumers to share content with other users. This is like Netflix. Digital service contract. You can share your Netflix password with any other person. Are you with me? Are you here? Digital service contract. This is when you are allowed to share content with other users. Example is Netflix. Is that clear? Then we have distance contracts. This is when you buy online, maybe Amazon, or you buy through your phone. That is digital distance contract. Do you understand the different type of contract we have here? Distance contract is when you buy online by catalog or over the phone. We have digital service contracts when you are allowed to share content with other users like Netflix. Digital content contracts when you are allowed to be supplied content in a digital form like ebook. Contract for services when you are allowed to, when you are engaged with a trader for services like teaching, sales contract, when you buy a physical good. These are types of contracts of consumers. Now go to Sales of Goods and Supply of Service Act of 1980. The Sales of Goods and Supply Service Act of 1980 is a key Irish legislation that protects the rights of consumers. It's about protecting the rights of consumers. Is that clear? So what are the rights of consumers under the 1980 Service Act? Number one, so rights when buying goods. The first right we have, the first one we're going to talk about is your rights when you are buying a good, like physical good, like a car, a pen, or whatever, a phone. When an individual buys a good, they make a contract with the trader. So the first thing is, consumers are entitled to goods that are one, fit for purpose. So whatever goods that you are buying, the reason why you are buying it, it must be able to fit that purpose. So I'm buying a red pen. If I'm buying this red pen, it should write as a red pen. That is fit for purpose. A merchantable quality. A merchantable quality of merchantable quality. If I'm buying it, it must be in the right condition. You must not sell a pen that is not working to me. You must not sell it. You must sell a pen that is working when you're selling to me. As described, they must match the description in the package. So whatever is in the content of that product that you're buying in the package, when you are buying it, it must be the same in the course of using it. Correspond to sample. Sometimes sometimes people buy a product because they have used the sample. So if you have given me a red pen as a sample, and because of using the sample, I was influenced or I was convinced to buy a new one. So whatever I'm buying, it must be the same as the sample I used. That is correspond to sample. Sometimes consumers will buy a product because they have used the sample. There's a test market. So you're buying the product because you've tested the product. So that's why you're buying it. So if you're buying that product, the content, the product that you're buying must have the same quality of the sample. That is correspond to sample. Does it make sense? Let's go live again. Okay. So let's go live again. I don't know why. I think it's the network. Should I change my network? Let me see. The Wi-Fi is, let me go. The Wi-Fi is working. It's not working here. Let me pause this first. Sorry. Let me pause this first. Pause. Okay, something I'm going to try again later. So when buying a product, like I said, we talked about that. So now we go to the traders. Traders also have the responsibility to provide necessary instruction. So as soon as whoever you are selling to, you have to give them instruction about how to use the product. Supply the spare part included in this contract. If it's a new product, you're buying a phone, the accessories that are included must be there in the package. That is the point here. Install the product correctly. If you're buying an air condition, they might as well come here to come and install it to be in a good condition. Is that clear? Then buying second-hand good. No, it's not going to be it's not going to be part of it. So it ends with Sale of Goods and Supply Act about here, the 10th here. Right when buying goods, and that's all. Is it clear? Any question? So now let's go back here.
It's NDA.
Yes.